Hey guys, welcome to part 5 of my Investing 101 series. Why did I commit to an 11-part series? I don't know, but here we are, so let's get started. So if you're not aware, this is the Investing 101 series. This is part of an ongoing series, and you can find a link to the entire series in the description. You can follow along with the slide deck at the link that's shown on the screen, and it's also in the description. So this is part 5, and if you stuck with me this far, please smash the like button because part 5 took a lot of work, like 5 hours of planning and research. So it is currently February 2021, and recently that whole GameStop thing happened. So you may notice that I have Robinhood listed as one of the future episodes of this series. I don't think people are too keen on joining Robinhood now, so I may briefly discuss Robinhood, but also discuss some alternatives that I've found to Robinhood. Just for full disclosure, I'm continuing to use Robinhood because honestly, that's a whole video in itself, so maybe I'll do a long rant about Robinhood. But anyway, I am going to keep using Robinhood, but I'm also going to start using some other apps in addition to Robinhood. Hopefully I can just kind of pivot on that episode and turn it into kind of a holistic view at the zero commission fractional share market of apps right now. But with that out of the way, let's talk about this video, which is the fundamentals video. And here's a general outline about what I want to talk about. First, I want to talk about why fundamentals are important to think about. And then I want to briefly mention the terms technical analysis versus fundamental analysis. And then I want to go over some of the easiest indicators you can use to figure out how valued a stock is. And those are the PE ratio, and for growth stocks like technology stocks, the PEG ratio, which is probably a better indicator than PE ratio. And then we're going to talk about cash flow, which is kind of a scary topic, but we'll get through it together. Don't worry, we'll get through it. And then I'm just going to briefly go over an example, and this example will be Apple stock, which I think is a pretty solid stock. And we will discover together if I think that it's a good investment right now or not. And let's just put this right out there. Right now, hashtag not financial advice. I'm not telling you to buy Apple stock, but we'll go over it and I'll give you my opinion. So why learn fundamentals? Well, ideally, stocks only go up and to the right, but it's often the case that stocks will go down, and this is not good. If you learn how to use fundamentals to guide your investing decisions, then two benefits that come to mind. First of all, you're going to mitigate some risk because you have a better understanding of the company and the business model that they have, and you can look at the financial statements and figure out if they're doing something fishy or if they're hemorrhaging money over time. See how risky their decisions are there. And you can gain confidence because you picked a stock that you are convinced is a good investment of your money, and you believe that it will have a high chance of returns. All right, so I'm going to briefly mention technical analysis versus fundamental analysis. Technical analysis means you're looking at the shape of the graph. You look at historically and you see like you had, an average rate of return of 8% per year. So you're basing your decision on whether or not that's a good stock based on historical data. So there's a lot more of a specific definition of technical analysis, but that's kind of the 100-yard view of it. And then there's fundamental analysis, which relies on understanding the business model, the overall financial situation of the company, and it gives you a good estimate of what the future value of the stock would be. So let's talk about one of my favorite ratios, which I've talked about over and over in this series so far, the PE ratio. And the PE ratio is a good indicator of what the value of a stock is right now, whether it's undervalued or overvalued. Generally, I think my recommendation in a previous video was it should be around 10 to 20. That's a decent PE ratio. And if you want kind of an intuitive answer for what PE ratio means, it's basically answering the question, how much are you willing to invest per dollar of a company's earnings? So if a stock price is $20 and their earnings per share are $1, then that means that they have a PE ratio of 20. And there's a really easy way to figure out what the PE ratio is, and that would be Googling the stock symbol and then looking for the PE ratio, which is usually listed right there. Sometimes it doesn't list it and you have to dig a little bit more. I don't exactly know why it doesn't list it at some points. In some cases, I think maybe whenever it's more volatile, it's kind of harder to estimate, and I actually have a good example of that that in an upcoming slide that I'll show you. Just so you get an idea of the overall market, here's the PE ratio for the S&P 500. Hopefully you know what the S&P 500 is, and if you don't, then that would be in one of my previous videos, the basic terms video. But anyway, as you can see, the PE ratio for the S&P 500 was kind of around like the 10 to 20 range for a long time. Recently, it's kind of shown some problematic trends. You can see that gigantic spike where it went way up and then came way down. That is the 2008 crisis. The spike to the left of that, right around the year 2000, that was the dot-com bubble. And the current increase in the PE ratio that you're currently seeing is the market in real time. So that might be some cause for concern. Take that as you will. There are some limitations to using the PE ratio to determine the value of a stock. One of the limitations is that it's a trailing indicator, so it's an indicator of past performance and not an indicator of future performance. And to understand the future performance of a company, you really have to look at the balance sheets, and you have to understand what the company is doing kind of holistically, what kind of products they expect to deliver to customers in the future that might be groundbreaking. In the case of Apple, they're working on the Apple Car, which who knows how that'll do compared to another EV product like Tesla's EV cars. And then Apple's also working on some VR and AR headsets that may pop up in the next few years. That might be a big market. And in general, PE ratios are probably not a good indicator of value. Well, they are a good indicator of value, but they're not a stable indicator of value for a volatile market. And so I just wanted to provide an example here. Let's click that first link. So I was curious about the PE ratio for GME, and if you Google GME and look for the PE ratio, it's not listed here. I'm not sure why. If you know why, let me know in the comments and educate me on this matter. But anyway, if you look at this page right here, I was curious. So the highest PE ratio was 310, the lowest was 0, the median was 910. So there's a pretty big imbalance there. That's a red flag for me. GameStop's earnings per share for the 3 months ended in October 2020 was 29 cents. So that was the earnings per share. The diluted earnings per share, I'm not going to get into diluted, but that's another variation of earnings per share, was negative 4.25. And yeah, right now the share price is 53. But anyway, results inconclusive. All right, so back on track. Another limitation is that the PE ratio doesn't account for growth, and the PEG ratio is something that's specifically used to solve this. So speaking of the PEG ratio, the PEG ratio takes either the expected or historical growth of the earnings per share into account to predict future growth. And so basically this growth in EPS is expressed as the percentage increase in the EPS. And so I provided an example here. Let's say your price per share is $46. EPS this year, 209. EPS last year, 174. The PE ratio can be calculated by taking the price per share and dividing by the EPS this year. And that gives us a PE ratio of 22, which is pretty reasonable. And then you use the percentage increase formula, which I have linked for your convenience in the slide, in order to calculate what the EPS growth is 1 year over the other. And that comes out to 20. And so you plug those into the formula. PEG equals 22 divided by 20, which is 1.1. And you're probably wondering what that ratio means. Is that good or bad? Well, generally, if you have a PEG ratio that's less than 1, then that means that it's an undervalued stock potentially, and may be a good buying opportunity. If the PEG ratio is greater than 1, then that would mean that it's overvalued. But even if the stock is overvalued, it might still be worth investing into. And I guess that kind of spoils the example that I'm going to be going over in the future. So yeah, spoiler alert. Let's talk about cash flow before we get to our spoilery example. So cash flow is an important part of understanding the flexibility of kind of spending and financial decisions that a company might have. If they don't have a lot of cash flow, and this kind of comes in different forms, there's different metrics for measuring cash flow. If they don't have good cash flow, then that means that if there's market volatility or some kind of tragic event like the pandemic, for example, then they're not going to have a lot of flexibility in what they can actually do with their extra cash. So, they might have debt obligations that they can't meet because they don't have as much operating cash flow, et cetera, et cetera. So there are 3 types of cash flow. Operating cash flow is revenue that comes in from conducting business and revenue that flows out from paying workers or paying for services. Investing cash flow is basically selling and buying investments. And then finally, there are financing cash flows that involves debt, it involves stock repurchases, it involves dividend payments to investors. So let's talk about some of the things that you can do. This is kind of more advanced, so I'm just going to kind of gloss over these, but one good ratio that you might want to look at is the debt service coverage ratio, and that's a ratio of net operating income to short-term debt obligations. What does that mean? Well, net operating income is basically earnings before interest and tax, and debt obligations is, basically anything involving paying off debt. Free cash flow, this is an important one. It's operating cash flow minus capital expenditures. So there's the definitions of those. Pause the video, look back if you need to. Unlevered free cash flow. This is complicated, and I just wanted to include this so you know how complicated this is. But anyway, to get the unlevered free cash flow, you take your earnings before interest, taxes, depreciation, and amortization, which people abbreviate as that acronym right there, or initialism. Yeah, I think that's an initialism. Capital expenditure, and you subtract capital expenditures, which we talked about on the previous slide. Capital expenditures are the purchase, maintenance of equipment and property. And then you subtract working capital, which is the difference between current assets and current liabilities. Then you subtract taxes. Ugh. Unlevered free cash flow is basically kind of a trick that companies use if they have high levels of debt. It makes their financial statements a little bit more pleasing to the eye, to the investor eye. There's a different version of this called the levered free cash flow, and levered free cash flow is that previous term, earnings besides, interest, taxes, debt, and amortization, minus change in net working capital, minus capex, minus mandatory debt payments. If you're still with me, I'm sorry that I'm putting you through this boring material, but I'm just showing you that there's a lot to learn about fundamentals. You can basically start out simple with PE ratio and PEG ratio and get progressively more complicated if you want to know more about your company in debt. And the more you know about the company, generally the better of a financial decision it is. So let's go through an example, and I promise in the next video when I go over a basic strategy, it's not going to be this complicated. I'm going to introduce some risk mitigation strategies and introduce some basic concepts when it comes to stock picking. So don't worry, it's not going to get this complicated. But let's go through an example with Apple real quick, just to kind of show you what we're doing here. So first you want to figure out what the PE ratio is. And spoiler alert, the PE ratio is 37.14 right now. And you can get this pretty easily by just Googling AAPL, which is the stock ticker symbol. And if you look down here, you see the PE ratio. And it's very convenient that you can find it that easily. There's a bunch of other stuff that you can find pretty easily. Market cap is a big one. We talked about that in basic terms. Dividend yield is a big one. We talked about that. There's a lot of useful information here. If you want to see more information, you click that more button, and then you see a bunch more information. I feel like Yahoo Finances does an even better job of showing all the financials for a company, which, spoiler alert, we'll be getting to in another link that I'm clicking. And then once you see that the PE ratio is a little bit high, but not even remotely high compared to Tesla's PE ratio, which looks like this, 1300. Wow. But anyway, you see the PE ratio, you say, okay, that's a little bit high. So you go ahead and you calculate the PEG ratio. You could calculate it from scratch by looking at the annual report, which I did. And if you scroll down, so this is where I found the data that I was looking for. Under item 6, selected financial data, you basically see the earnings per share for each year going back 5 years historically. So what I did was I took these two values, 2017 versus 2016, and I calculated the percentage increase, and I calculated percentage increase for these years, and for these years, and for these years, and then I averaged them and divided that into the PE ratio. That gave me a PEG ratio of around 2.9. And this was a trailing PEG ratio. I believe what Yahoo Finance shows you is the forward PEG ratio, which was very similar actually. So you have a bunch of ways that you can do this. I think if you Google stock ticker symbol followed by PEG ratio, you should be able to find a reasonable answer pretty fast, usually from Yahoo Finance. And then just kind of going through the rest of this example, I kind of gleaned this information from the latest quarterly report. And so if we want to take a look here, let's find it in the table of contents. Yeah, here we go. Cash flow. Here's the cash flow statements. So basically you see every everything itemized. And pro tip, if you see a value that's in parentheses, then that means that it's a negative value. So, you take each of these itemized items and you put a negative sign when you're summing them up. And so if you add all these up, subtracting the ones in parentheses, you get total operating activities or operating cash flow of 38,763. And then you add all these up, you get a negative, important to mention that if you look up here, it specifies that these values are in millions. So if you see 38,763, that actually means 38,763,000,000. And then you can add everything up for here and you get negative 8.5 billion in investing activities. And then here for financing activities, you see negative 32 billion. And if you look up here at the top, you see cash equivalents, cash equivalents, and restricted cash beginning balances. So that's basically how much assets they have at the start of this period. And at the start of the period that they had 39,789,000,000. And at the end of this period, they had 37,719,000,000. Their total assets went down by about 2 billion. Looking historically at December 2019, they started with 50 billion and they ended up with 41 billion. So they're definitely burning through a lot of cash and reinvesting it. I looked kind of at the broken down version of this, and they were basically doing a lot of stock buybacks, which I don't exactly know why, because their stock price is actually already pretty high. So maybe they're pretty optimistic about future growth. Oh yeah, let's just look at what Yahoo Finance shows us. So Apple cash flow. If you Google Apple cash flow, then the first link for me is the cash flow statements summarized by Yahoo Finance. Yahoo Finance is a great resource for this kind of stuff. You can expand and collapse so that you can see like every single item that's in these nested categories. So if you look at Apple's cash flow statements, you can kind of see their end cash positions. So this is how much total assets they have at the end of each of these years, or at the end of each of these periods, this is the annual report, so it's the end of each period. So we have 20 billion, 25 billion, 50 billion, 39 billion. So they have a healthy amount of cash here. If you look at their free cash flow, 50 billion. Yeah, these are in thousands. So all numbers are in thousands. So free cash flow, 50 billion, 64 billion, 58 billion, 73 billion. So yeah, they have a healthy amount of cash flow. They're doing quite a bit of stock buybacks here. Capital expenditures are actually going down, which is a good thing. So there's a lot of things that you can understand about the company by looking at all these numbers, especially if you compare the trend from year to year. I know this is fairly complex, but after a bit of practice, it should get a little easier. In fact, this is actually my first time looking at cash flow statements and as part of doing research for this video. And I'm already kind of feeling somewhat confident with understanding what all of this means. So, if this is something that's interesting to you and you want to actually pick a few stocks of your own, without just relying on some YouTuber or some financial advisor telling you that it's a good buy, then I think it would be worthwhile just poking through Investopedia, which I'm linking in the sources for my slides. It'd be worthwhile to just go through and learn some of the basics of these concepts. That way, if you're deciding to throw a bunch of money at a stock, then you can at least first check all the basics and make sure that it's a good investment. But anyway, that's an example that I wanted to go through. You can do the same thing for Tesla, and I'd be very interested in seeing what you find out from going through Tesla. So if you look at the cash flow statements for Tesla, let me know what you find in the comments. I'll be very interested. So this was the fundamentals video. In the next video, I'm going to be going over strategy that I'm using in 2021. So whatever strategy that I'm using for my personal finances is the strategy that I'm going to present in the next video. So hopefully I can get that video out pretty soon. I'm sorry that there was a 2-week gap between this video and the previous video. I'm going to try to cut that down to 1 week per video. And if that means not releasing any other type of video for the next few weeks, then so be it. After that, I'm going to go over Acorns, which I still think is a good investment app. And then I was going to go over Robinhood, but I may change this up a bit and go over some other apps that are similar to Robinhood and kind of give my opinion on what happened with the GME short squeeze and the subsequent issues on Robinhood. After that, I'm going to kind of go over my portfolio spreadsheet and kind of refresh it with all the new investment strategies that I'm going through in 2021. And then I'm going to review M1 Finance just because it lets you kind of automate your portfolio slices. And then finally, I'm going to have a video talking about what's next, crypto, real estate, whatever else might come up. So stay tuned for the rest of the series. I'm going to try to stick to 1 episode per week going forward. Let me know in the comments what you think about the series so far. Let me know if you have any critical feedback about like the pacing of the videos or how much detail I go into or don't go into. So let me know in the comments. Big shout out to my editor who's going to have to go through 32 minutes of footage. And speaking of 32 minutes of footage, I think it's time for me to end this video and also plug my Discord, which I think you should join. Please join my Discord. We have lots of fun discussions in there. If you consider the topics on my channel fun, that is. But anyway, that's it for this video. Smash that thumbs up button, smash the subscribe button, hit the notification bell. That's pretty much it. Do those things and do some other things that I didn't think of. Yeah, see ya.